Welcome back to Market on Close. I'm Caroline Woods filling in for Oliver Rennick. It's time to welcome in Tammy Trenta. She's founder and CEO of Family Financial. Tammy, thanks so much for joining us.
Thanks, Carolyn.
So Tammy, let's start with the bank earnings. So far we've heard from JP Morgan, Citi, PNC, Wells Fargo. Mostly beats, but kind of mixed stock reaction today. What stood out to you in these reports?
Well, it's obvious that, with the banking turmoil that happened a month ago with Silicon Valley Bank, that a lot of these larger banks have been the beneficiary of those fleeing deposits. So that boded well for some of these financial stocks. The other thing is a lot of these banks have been positioning themselves for a while to go through a challenging time with how interest rates have increased. So, upbeat, but I don't think we're out of the woods yet. I think that there's, another 6 months of uncertainty. So perhaps it's that the market is looking past that uncertainty, but, there's a lot of headwinds right now.
Well, when it comes to PNC, actually, you know what? We did see shares pop back. They ended up closing up about 0.4%. So after being lower for a lot of the day, did see a little bit of a late day rally. But they saw net interest income decline, right? And it just kind of went to show that they have to pay more money to help to make people keep their money in their banks, especially versus some of the other, the bigger names. So what can we extrapolate maybe from PNC's results as we look ahead to the regionals next week, given the fact that PNC is kind of a super regional?
Yes, so I think that that's a really good point, Carolyn. So the net interest income is one important factor, and I think the banks now are balancing trying to placate the consumer, give the depositors confidence in the banking system, but we really have to take a step back and look at how banks are making their money and how they expect to make money in the foreseeable future. The other thing that needs to be looked at are some of these loans that are coming due that are resetting. And banks have already been positioning themselves to have losses on those. And so there will be regional banks that don't make it through the next year. And if it's bad for the regional banks, it's going to be bad for the big banks as a sector. So I think we need to proceed with caution on any of these financial stocks. I know when we last spoke, there were also bank earnings being released for the first time this year. And, people were more optimistic, and then Silicon Valley hit. So I think we really need to be cautious about investing or putting money in banks and, as an investment.
So cautious on the banks, not a buyer on the banks. We'll also hear from United Airlines next week. Delta missed, but gave a pretty upbeat forecast, I would say. So what are your thoughts on airlines as we head into what could be a mild or possibly more robust recession, and as we continue to see oil prices on the rise?
Yeah, so I think investors need to remember that regardless of whether we hit a recession or a slower period of growth in the economy, one of the top three things that consumers stop spending money on is discretionary, and travel is right up there. So we're entering the summer, so it's not surprising to me that many of the airline stocks are more optimistic because we've expanded. There's more travel now to Europe, and that's a good thing for the airlines. But we still have the headwinds where Saudi Arabia has now cut oil production. That does not bode well for the airline industry. And, regardless of how, semantics, how we want to define the next 6 to 9 months of this year, we're still in cautious territory. So I'm not optimistic about the airline stocks either right now. But what I will say is stocks are most depressed at a time of uncertainty. And so I feel like we're at a point of uncertainty right now. Fed doesn't make another rate announcement until May. And so we've got a period of time where I don't know if we're going to have that clarity. We still have signs, finally, after, 15 months of rate increases, we're starting to see signs of slowing. We're seeing, more than the tech sector doing layoffs. We're seeing retailers laying off. We're seeing banks laying off. And that's like a necessary evil, so that banks can continue to make money and stocks can continue to make money. But I don't think we're out of the woods yet by any means.
Well, let's talk about earnings more broadly speaking, because earnings expectations have come down quite a bit. I was looking at a Refinitiv poll. Analysts said S&P 500 earnings fell more than 5% in the first quarter. Do you think expectations are low enough? Do you think that we could actually maybe surprise to the upside, or there could be more downside surprises that expectations haven't come down enough?
That's a great question, Carolyn. Last year, a lot of times when banks are announcing, they're trying to posture, right? They want to set expectations for the investors. And so, they were cautious with earnings in order for them to exceed expectations. And now I think that the overall economy is sort of pricing in this decrease going forward. So I think it's anybody's guess, and it really hinges on what the Fed is going to do at the next rate announcement.
All right, we'll have to leave it there. Tammy Trenta, founder and CEO of Family Financial. Thanks so much for joining us. Great to see you again.
Thanks, Carolyn. Have a great weekend.